Welcome. In this video, Zbcn coin is ready to increase by 275%. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
A bullish order block is one of the key concepts used to track the market-making moves of institutional investors and large funds. As the name suggests, a bullish order block represents a specific price area where the market shifts from a downtrend to an uptrend and where large buy orders come into play. This area often leaves a mark on the chart as a place where the price reacted sharply to the upside in the past. For this reason, technical analysts see these zones almost like a liquidity pool. When the price reaches that level, buyers are expected to step in again and push the price upward. In the current scenario, having a bullish order block just below the price means that if there's a drop, the price could bounce back strongly from there. Such zones are often levels where big players have taken positions in the past. When institutional investors want to accumulate an asset, they don't usually do it in a single trade, because buying huge volumes all at once would instantly push the price higher and make it more expensive for them. Instead, they pull the price to a certain level and slowly accumulate liquidity there. The area formed during this accumulation process is recorded as the bullish order block. Later, when the price returns to that zone, similar reactions may occur due to leftover orders or new incoming buying interest. One of the most important characteristics of a bullish order block is that it acts as support. Support levels generally come from a combination of psychological and technical factors, but order blocks are a bit different. Here, support is not only reinforced by investor psychology, but also by large volume trades that have actually taken place in the past. This increases the likelihood that both technical traders and big players will buy simultaneously when the price reaches that level, causing a sharp bounce. To understand how these zones work, you need to look at microstructure. When the price approaches a bullish order block, there may be many pending limit buy orders in that zone. As the market price reaches this area, these buy orders halt the decline and turn the price upward. Sometimes these reactions are so strong that the price shoots up from that level like a spring. This creates opportunities for short-term traders and entry points for long-term investors. Bullish order blocks are usually identified by looking at past price action. The last bearish candle before a big upward move often forms the lower boundary of the bullish order block. This is because big investors start accumulating during that last decline, and the following rally indicates that the accumulation process is complete. Therefore, when the price revisits that level, a strong buying reaction is expected again, just as it happened before. In the current case, having such an area right below the price strengthens the perception among market participants that even if the price drops, it will bounce back from here. Of course, this mechanism does not always work perfectly. Sometimes market conditions change, fundamentals turn negative, or big players decide to shift their positions. In such cases, a bullish order block can be broken. This breakdown often leads to sharp declines because stop-loss orders may be clustered just below that area. That's why traders using bullish order blocks must apply risk management. Stop levels are often placed just below the order block so that if the zone doesn't work as expected, losses are limited. The timing factor is also important in the effectiveness of bullish order blocks. The more recently an order block is formed, the stronger it may work, as the market's memory of that level is still fresh and the intentions of big players remain relevant. However, very old order blocks can lose their impact because market dynamics may have changed over time. Therefore, when analyzing, the freshness of the order block and recent volume data should also be considered. The bullish order block just below the price currently acts as a source of confidence for traders. If the price pulls back toward this zone, it could react strongly upward from there. The strength of this reaction depends on the buying demand at the time, the overall market trend, and the current news flow. If the market is generally positive, the bounce from this block could be very sharp and may even push the price above its previous levels in a short time. Some traders see these zones as a launch pad. The price comes down to them, consolidates for a short while, and then accelerates upward like a car shooting off a ramp. This analogy nicely summarizes how critical bullish order blocks can be, especially in volatile markets, because these areas are not just places where the price pauses, but where a new upward wave can begin. In conclusion, the bullish order block just below the price is a very important level, both technically and psychologically. This area is remembered as a place where strong buying occurred in the past and the price started an upward move. When the price reaches this level, the likelihood of a strong reaction is high, just as before. This means traders should watch these zones closely and shape their strategies accordingly. If market conditions are favorable, a move starting from this block could take the price to much higher levels in a short time and generate significant profits for investors. But we cannot make decisions based only on the order block, so let's look at the other metrics as well. Keep watching.
The MACD indicator is one of the most widely used technical analysis tools to understand market trend direction, momentum strength, and possible reversal points. In particular, when an upward crossover occurs, this is often considered a sign that strong price momentum may be starting. An upward crossover happens when the MACD line crosses above the signal line from below, and this crossover is frequently perceived by investors as a buy signal. After such a signal, a sudden and sharp price increase, commonly referred to as a pump, may begin. To understand the logic of MACD, you first need to know its structure. The MACD line is the difference between two exponential moving averages, typically 12-period and 26-period. This difference shows us how much short-term momentum differs from long-term momentum. The signal line is generally the 9-period exponential moving average of the MACD line. The interaction between these two lines helps us understand the direction of market momentum. When there is an upward crossover, it means that short-term momentum has surpassed long-term momentum, which usually indicates the start of an uptrend. In the current scenario, the possibility of an upward crossover we are talking about, combined with the current price position in market psychology, could signal a strong move ahead. In technical analysis, such crossovers indicate that investors are starting to enter the market on the buy side. If volume supports this signal, the likelihood of accelerated price movement is very high. Volume is one of the most important factors confirming the MACD signal. That is, if an upward crossover occurs and trading volume also increases at the same time, it strongly implies that new buyers are entering the market and prices are likely to rise. The rapid increases we call pumps usually occur when market participants collectively start buying. When MACD gives an upward crossover, many traders see this signal and open positions simultaneously. Especially in the case of algorithmic trading bots and automated buying systems that follow these signals, buying can be triggered in a chain reaction. As a result, prices move sharply upward in a short period of time. This movement can happen within minutes or hours. In cryptocurrency markets in particular, such pump movements can occur much faster and more sharply because the market is open 24/7 and has high volatility. Not all upward MACD crossovers are equally strong. Some occur in sideways markets or during periods of low volatility, leading to limited price movement. However, if the price has already bounced from strong support, the overall market trend is positive, and volume is increasing, these crossovers become much stronger signals. This is where the sudden rises we call pumps begin. The magnitude of the pump depends on market supply-demand balance and investor enthusiasm. Another reason the MACD works after an upward crossover is the shift in investor psychology. In a downtrend or sideways market, investors are usually cautious, but when the MACD makes an upward crossover, it technically signals a trend change. After this signal, investors who were previously on the sidelines enter the market, adding a new wave of demand. As demand increases, the price rises quickly. The crossing points of MACD may not always be sufficient on their own, which is why traders often also examine the histogram. The histogram shows the difference between the MACD line and the signal line. When the histogram begins to shrink after going negative, it indicates that downward momentum is weakening and the crossover is approaching. When the histogram crosses above the zero line, the upward price momentum often becomes much clearer. Another important aspect of the MACD signal in creating a pump is the perceptual trigger effect. Since most market participants watch this indicator, the signal itself can trigger a move. You can think of it as a domino effect. First, a small group of technical traders starts buying. These purchases push the price up slightly. As the price rises, more investors think the uptrend has started and join in. In the final stage, news of the rise spreads on social media, prompting even more people to buy. This accelerates the move and turns it into a real pump. However, one point to keep in mind is that not every pump is permanent. Some pumps result from short-term profit-taking and are followed by a rapid pullback. Therefore, when investors see an upward MACD crossover signal, they should also check support resistance levels, trend structure, and volume data. If the price is just below a major resistance and selling pressure is high there, the pump may be short-lived. But if resistance is broken, the move can be much stronger and more sustained. One of the most ideal scenarios in upward MACD crossovers is when the price simultaneously breaks an important technical pattern to the upside. For instance, if a downward trend line or a triangle pattern is broken to the upside at the same time the MACD crosses, this double confirmation can cause the price to rise rapidly. Both pattern followers and indicator followers enter the market at the same time, significantly increasing buying pressure. As we mentioned, if the MACD is likely to make an upward crossover, and this aligns with the current price structure, there is a very high probability of a sudden and strong upward movement. The duration of the pump depends entirely on the general market conditions, news flow, investor interest, and trading volume. But as has been seen many times before, especially in the crypto market, it is not surprising for prices to increase by tens of percents within hours after such signals.
The cup formation is one of the most well-known and powerful patterns in technical analysis that investors frequently follow, especially when it forms after a long-term decline or a sideways market movement. It gives strong signals that the price may recover again. The cup formation basically occurs when the price first falls gradually, then slowly forms a bottom, and then rises again to return to its pre-decline level. This movement creates a shape on the price chart that closely resembles a half circle. In the current scenario, after this cup is completed, the price has entered a small pullback and sideways movement on the side, which is called the handle. The handle acts like a resting area necessary for the continuation of the formation and allows the price to gather strength again. The handle part is actually very important in understanding market psychology. As the price rises from the bottom of the cup, some investors may want to take profits. This selling pressure may cause the price to pull back slightly. However, this pullback is usually not very deep, and the price stabilizes just below the peak point of the previous cup. The short-term sideways or slightly declining channel that forms at this point is considered the handle. When this handle is completed, that is, when the price breaks upward, buyers re-enter the market strongly and an increase equal to the depth of the cup is expected. In the scenario you mentioned, the depth of the cup corresponds to approximately a 275% potential increase. This is an extremely striking figure for investors because such formations, especially in highly volatile markets, can reach their targets in a very short time after a breakout. A 275% increase potential shows that even small investments can turn into significant profits. This is why cup and handle formations are often followed patiently by medium and long-term investors. The cup formation process usually takes a long time. During this period, the market exits the downtrend and slowly begins to recover. Investors' confidence is regained, trading volume increases, and market sentiment shifts positively. The handle part is like the final turn of this long journey. In the handle, the price rests a bit, short-term hesitations form in the market, but the strong trend remains intact. After the handle breaks, the price usually rises sharply because this breakout causes undecided traders to join the buyer's side. The main reason why this formation works is the supply-demand balance. While the price slowly recovers in the cup part, most investors have not yet fully regained confidence. But when the price approaches old peak levels, those who sold at those levels in the past or closed their losses leave the market. During the handle, the remaining selling pressure is also absorbed. Thus, when the price breaks upward, there is no significant selling wall ahead, and the path for the rise is clear. This significantly increases the probability of reaching the target. There are also some technical conditions for the cup and handle formation to work. First, the handle part should not be far below the depth of the cup, meaning there should not be a sharp drop. The ideal handle forms at most 30 to 35% below the cup's peak point.
This is because it preserves the strong probability of the price moving upward. Also, an increase in trading volume at the time of the breakout is a critical confirmation. If the handle breaks without increased volume, the breakout may be false and the price may fall back. However, breakouts accompanied by a volume surge are much more reliable and have a higher chance of reaching the target. From a psychological perspective, the handle breakout sends the message, "The trend is continuing," to investors. Those who saw the market recovering in the cup part but were late to enter often decide, "I must get in now," when the handle breaks. These new buyers push the price even higher. At the same time, the handle breakout usually triggers stop losses for investors holding short positions. This creates additional buying pressure and contributes to a rapid price increase. Especially in the crypto market, such formations can work much faster because the markets are open 24/7 and the investor base is very large. Developments like a handle breakout spread very quickly on social media, which accelerates the price movement. That's why the cup and handle formation is almost like an opportunity alarm for crypto investors. When identified correctly and supported by technical confirmations, it can provide high returns in a very short time. When all these factors come together, the current scenario with a 275% target potential really looks exciting. If the price completes the handle and breaks upward with high volume, it is likely that this movement will be strongly supported both technically and psychologically. In such a breakout, patient investors will be rewarded, and those who entered early can earn significant profits.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.